Andisa Ramavunga is here with me in studio. He's group chief advisor at the Diniso Consulting Group. Andisa, thank you so much for joining me once again, my brother. I really appreciate your time. Let's recap. Let's get back to this conversation we started 2 weeks ago, the income statement. But we want to insert into this conversation the idea that, first of all, we want to make it practical, but also, how does it help us understand the value of our business? Good evening to you.
Good evening, Aubrey. Yeah, so I think it's quite important, and you raised a good point around the practicality of what we are talking about. I guess what we are not trying to do is make people into or turn people into accountants, because as an entrepreneur, there's a certain level where your business needs to get to before you get to even grapple with financial statements. And even when you get to that level, the chances are you won't be doing it yourself, but you'd be outsourcing that to a qualified accountant. But we need to understand as entrepreneurs that accountants are just that. They account for stuff. They break down stuff into what you call academia. I call it principles of accounting, which really are a basic principle of how to organize information so that it's coherent and it makes sense, and you're able to allocate like topics, and you are not creating confusion. So that's what they do best. But what accountants, sometimes they will help you, but why is it important as an entrepreneur to understand this? It's because we are not accounting for value creation. We are creating it. And for us to be able to create that value, we need to be conversant with the tools that are there to account for it.
You've got to say that again, brother. That was beautiful.
Yeah.
We are not accounting for value creation.
Yeah.
We are creating
the value. And we therefore need to be conversant.
You're going to stay there for a second with me. Because that is so important, right?
Yeah.
I mean, the entrepreneur is a value creator.
Yeah.
Whereas the accountant is the person that is giving account of that value that has been,
where things have gone.
That is so important.
Yeah.
Let's move on.
Yeah. So we've had a series of this, and I'd like to draw people to our past conversations, because you can quickly get lost in the technical jargon and nuance of what we're talking about. But it's important to keep a big picture, and I'll want to refer people to our website where we capture these podcasts, www.dinisoconsulting.co.za, and we've got a series of all of them from when we started talking value creation, because we are at but one point in time where we are now looking at how to value the value that we create. Excuse the tautology there. And there's no other way of valuing this or accounting for this value without using what we call financial statements. And there's a number of reasons why you compile financial statements. Others are for compliance reasons, but that's not, I guess, the gist why you and I are there. But they are there for us as entrepreneurs, so that we are able to determine whether we are creating value or not, and we are able to determine whether we are, more importantly, destroying the value, and whether we are making progress. Because over time, year in, year out, or if you keep your financial statement periodically, other people do keep them on a quarterly basis. Diligent entrepreneurs, I would say, keep them on a monthly basis. It's quite important to read them in that context, so that we are able to track where you started and how we are moving, but using the financial language. Because again, that's the financial language that you'll use to interact with the world. It's quite important, because you can now start creating your own language. It becomes very difficult to have a conversation with external stakeholders like the financiers, both debt funders, equity funders, or if you are to attract like-minded people who are to join your venture, you need to have, at some point, besides the strategic conversation, you need to have a financial conversation. So we started with a balance sheet as a store of value. And we said there were three items that an entrepreneur need to be aware of. There is the assets, which really is the balance sheet. And the assets is a function of two things. How those assets are funded, either through equity, which is sweat, or through debt, which is money that you lend from other people. So those are the three things that I guess would like to impress upon on the balance sheet. We then moved on to the financial statement, which is now the creator of value. Remember, I said, look at the balance sheet almost as a factory. And you look at the income statement as the product leaving the factory, going into the market and bringing in the money, which is the value, and storing it in the balance sheet. And there are a couple of things, and I would say 3 things that we started discussing there, or 4, if you include revenue. We said there's revenue, then there's direct cost of producing the service or goods. That gets you to, so you deduct that, you get to what we call the gross margin, which, if you've heard, gross margin is very important. And it only has to do with producing goods and generating money from those goods and deducting the costs that are only associated with producing those goods. We then went on to the concept to say, once we have the gross margin, let's talk operating margin. And operating margin, that's when you subtract the indirect costs. We said it's marketing, getting the financial guys to do the books, getting administration and marketing and all those people. And then you get into what we call an operating margin, which is a very important line in business, in lingo. Other people, we call it the operating margin. Other people will call it EBITDA, if you've heard of that term. That is called earnings before interest, depreciation and amortization. And I sort of suspended the depreciation and amortization part, if you remember, because I said, let's not complicate the conversation.
Depending on the maturity of that business.
How old are the assets,
right.
Whether there's impairments or not in the creditors. You then have to account those through depreciation, age of the asset, amortization, it's impairment of sometimes some of them are non-tangible assets, by the way. Things like software, IP that you would have bought. But let's suspend that, because most people are not quite there. I think I'm more interested in us grasping the basics of how to measure that value. So for me, it will be gross margin, it will be operating margin, because all these are almost like not asset, but efficiency measures of how well you do in spending your money. Operating margin is very important for me because, again, if you go back to the funders, what they were looking at, it will be operating margin. And we'll come back when I talk financial ratios to talk something that's called interest cover, by the way. So funders will be very interested in that, to say it's the multiple times that we are able to cover the interest. So that's a healthy indicator for if that's positive for financiers to look at. So once you have your operating margin, you then deduct your interest costs, and then you deduct the taxman's cost, and you have what we call the net margin. And this is what you've created in that particular year, or that particular month, or that particular quarter, depending on the period you're looking at. And then you take that to the balance sheet, as I've linked it before, through what we call retained earnings. It becomes the owner's equity part of your business. So that's where we were, I think, at the point in time. But I think we and you mentioned something very important. If you think about the income statement, what exactly it is, it's think of it as a budget. Sometimes you can even set it up front, right? Before you even spend the money, to say, okay, I'm expecting this much sales. This is how I'm going to spend the sales. This is what I expect as a gross margin. I expect my operating or overheads to be this much. This is what I expect as an operating margin. I know my assets in the balance sheet, and they're funded through debt, some portion of them. And this is what I expect as the interest component of those assets. And I can have a healthy business. So it helps entrepreneurs focus and plan and forecast how the operations would be. And it helps, again, for entrepreneurs to come back month on month to assess those things, whether we are meeting budget or not. And if not, you are able to adjust, whether it's the cost line, to say, look, I'm selling too little of the thing. Maybe I need to pump up the marketing a bit so that I sell a lot. Or I've overspent on the ingredients as a cost of direct sale. Maybe I need to reduce the wastage a bit so that I'm able to sell the consumer rate revenue without increasing the direct cost. So again, it helps, I guess the point I'm trying to do, it helps focus the entrepreneur on operating decisions of the business.
Right.
Yeah.
Right. That's the point I wanted to just get out of there. That this document, the income statement, and its relationship with the what's the other document?
Balance sheet.
Also has the function of allowing you to understand which levers to pull in order to influence another section of your business. So if you're not doing sales, you then know that maybe I need to push the marketing side of the.
Yeah, absolutely.
So based on that picture, that snapshot, you can see what your business looks like and where the interventions are required to bring it to the level that you need it to come at.
Absolutely, because at the end of the end game is profitability. Remember, we spoke about it, and I sort of like maybe confused people with using the word surplus, because profitability, that's all it is. It's what's left. Net margin, by the way, or net profit, it's what's left from your income line after you've incurred all the costs that the business has to incur, including tax, by the way. And then you have the surplus or the net margin, because the end game is to maneuver those levers, whether it's sales or quantities or it's pricing, to determine the sales component, or it's about managing the costs. And you need to understand where are the drivers of those costs. And budgeting becomes a very essential tool that is available for the entrepreneur.
My guest is Andisa Ramavunga, Group Chief Advisor at Ntiyiso Consulting. We're talking about balance sheet. We're talking about the income statement, the relationship between these documents in your business. But I feel compelled to do what I'm about to do now.
Yep.
Oh, by the way, I'm still inviting you to join us. Whatever questions you may have, whatever comments, insights that you may have with regards to the income statement and the balance sheet. One of the things that makes many of us switch off when conversations of a technical nature about business are being held is because we haven't made the emotional connection between this information, which is contained in the balance sheet and the income statement. We haven't made the emotional connection in our minds for the need for those documents. And so they remain in many of our consciousnesses as entrepreneurs as a thing that the other people do, the accountants. And I want to impress upon the entrepreneurs listening now that, folks, it is no longer cool not to know these things. It is important for us as entrepreneurs to understand the balance sheet and the income statement, not as an accountant, but as the entrepreneur who is trying to create value and who is wanting to quantify it at each and every evolutionary stage of your business. It's critically important, because what that does, if I'm understanding you correctly, Andisa, is it removes you from just being a subsistence business person into a real professional business person. And a professional business person is the true value creator. And so we need to understand that is our mission as entrepreneurs in this economy, that we can't stay just subsistence. That's why I sometimes have issues with this idea that, people must stay small business. Small business. I'm a small business. Why do you want to stay small? But I think that the reason why we stay small is because we don't understand our role as entrepreneurs, that we are value creators. And that the understanding of the balance sheet and the income statement is not something just for the accountant. The accountant needs to put together a story using the language of commerce for other people, including yourself, to understand. But ultimately, you, the entrepreneur, are the value creator, and you need to understand that language too, if I'm understanding you correctly.
Absolutely, Brenda. I know it's hard, right? Because it's a function, again, of, I guess, the education levels that we have in the country. But it's also the function, because I remember as well being at school, how people used to fear accounting, maths, and all those things. And I do appreciate that people have certain phobias, but that's what we are trying to do, you and I guess. It's to demystify these things and
dissolve the phobias.
Yeah. What we will not do is make, as I've said, 10 people into accountants, or we would not even claim to make people financial geniuses overnight. But what we are trying to do is, one, to create familiarity, one, to whet the appetite of an entrepreneur enough so that they are at least comfortable to venture into this space and try understand that area of the business pretty well. But the work is still stuck with the entrepreneur to go out and try out these things. What we are trying to give them here is basic principles, and you'll see that I said balance sheet is 3 things. I did not mention a myriad of other things, because what we are trying to create is what we call first principle problem solving, and understand the building blocks or the basics. If you take out of this conversation that the balance sheet practically is the assets of the business, I think you would have started making a step. You then understand the subtle nuance that says not only does it tell you the assets of the business, but it also tells you how they are funded. That's why you've got the liabilities portion of the balance sheet, as well as the owner's equity part. All of them are in rands, by the way. So if you add them up together, it will equal the assets part. So it's 3 things around the balance sheet that at least we are equipping you to go understand and understand that it's when somebody asks you for a balance sheet, they're asking you typically, do you have assets? And there are different classes of assets. And I think that's where the homework for entrepreneurs goes in. And again, with the financial statement is to say, understand that there are 3 main areas. So we start, accept the revenue, obviously, because it's given as the top line. I'm saying, understand that there's the top line. After that, there's the direct cost, which gives you the gross margin level. There's then the overhead cost that gives you the operating margin, which is the second aspect. And then the last aspect is the net margin, where you account for interest that you pay to lenders, as well as the tax. In that order, by the way. You are not allowed to jinx it around. Even law doesn't allow you to jinx it around. Think about it this way, Aubrey. Who must get paid first if money is made? It's logic, right? That's why I love what the accountants have done. We might think of it as accounting standards, but the first people to get paid, it's only fair that are the people who produce the goods. Because without them, there's no top line, right? Okay, the next person who gets paid are the people who sell the goods and the administration part of it. Because without them, again, the goods don't move into, then the last people to be paid are the bankers, followed by the taxmen. And by the way, the entrepreneur is the last one to be paid, because it's paid by the surplus, right? The net margin. And that's why we take it into the owner's equity. So it's the hierarchy of nature, I guess.
But that is important.
Yeah, absolutely.
It is important for us to understand the logic of where the payments goes in understanding the income statement, right? Because then it makes us understand how to prioritize too. Yeah. So while we are creating a document that tells us about the value of the business at an academic level, if you're happy to use that kind of terminology, it's also an operational tool.
It is.
In the sense that it tells you how to allocate the distribution of assets and funds.
How often have you heard of the notion of an entrepreneur who buys a fancy car without paying their employees? Already they've violated the structure and it tells you already, that tells you that's not a good business, because it doesn't account for, you can't come at the end and take your money as an entrepreneur if you have not paid the people that produce the goods.
Because that's not your money.
It's not your money. In fact, you are stealing.
Yep. 011-883-0702. We're talking about the income statement and the balance sheet, folks. And I know that these conversations, at least for me, have been very intimidatory.
Yep.
Because I didn't understand why I need to know this. Why it's important for me to understand, what does the income statement of my business mean? What does the balance sheet mean? And what's their relationship?
Yeah.
Because we need to understand that relationship, that these are pieces of information that make you, the entrepreneur, understand the lay of the land as far as your business is concerned. But it is also a way of talking to the commercial world, but also a way of being able to understand how to operate your business financially, given the priorities as set out in the income statement.
And by the way, also operate your business strategically, because you can have a budget, by the way, of your own balance sheet. You can say, in this, I can aim to have the assets worth this much and in this class of assets, and this is how I'm gonna plan buying for them. Maybe in the initial space, I'll get investors to come in, and once I have enough investors, is maybe then get the debt funders to come in. Again, the balance sheet becomes a strategic management tool that allows you, and we've created the linkage, right? Because without the income statement turning on a surplus, it becomes it's a business that's built on quicksand, because you'll quickly see that it will be funded purely through equity, and which is not the right part of equity, because it means you'll be selling shares and shares and shares, or funded through the debtors, and you'll see at some point debtors won't touch you. So it's important to have that surplus from your income statement to populate your balance sheet, because that's the only way you can really grow your business. You can argue, and there's an interesting point in the US where you have the likes of I don't know now, but if you remember back in the day, those startups that had very little profitability, but they were getting bigger balance sheet, and the reason why they were getting balance sheet is because they were going to VCs, by the way, to get all the money. So it means venture capitalists. Right. It means they were growing. They were growing their cash assets in and obviously not only cash, but they were investing it in building software, doing all those other things. So they were growing the balance sheet, but they called it a bubble, by the way, because the income statement was not bringing in the money. Eventually they turned. Amazon turned. The good things with the likes of Amazon, these are people who are having surpluses that are crazy. Apple has crazy surplus that they are taking from the balance sheet year in, year out, from the income statement back into the balance sheet. So the health of the business, although I did say the principle to measure value ultimately, and we'll talk ratios now, is the balance sheet. But it's quite important to understand this, how you feel that balance sheet, which is a function of a income statement.
Juggernauts of companies that are simply too strong to fail, I suppose, if you understand it in those terms. I want to take some calls. Piri is in Alex. Good evening to you, Piri.
Good evening, Ops, and your guest. Thank you very much.
Go ahead.
Maybe please allow me, Ops, to just shoot my shot quickly.
Sure.
I actually have a BCom accounting degree, and I have a South African Institute of Professional Accountants certificate, and I was just looking at Mr. Andis's website there. I was just looking for opportunities in that space, if at all, Ops. But my question really is, looking at sets of financial statements, your income statement, your balance sheet, and your cash flow statement as well, how does one know that one is doing well or not? How do I measure whether I'm actually able to achieve my target? Do I look at how many products I've sold, or do I look at how much of the net profit or the value that I've gained, or how can I deduce that I am actually doing well generally? And if I were to compare my set of financial statements with another set of financial statements, how can I know that company X is doing much better than company Y?
Excellent question, Piri. Go ahead, Andisa.
I feel that is like a trick question, because he's an accountant. So it's a loaded question, and there are a number of ways that you can look at a business that's creating value. For me, it's really two things, and we have not spoken ratios as well, because we'll come to the point where you compare companies, which, by the way, it's another thing that entrepreneurs need to keep on doing. To me, it's your balance sheet. Basically, if you were to look at what we call, in jargon, is called the net asset value. The net asset value, simplistically meaning, is your equity component. It's when you take your assets, you minus your debt, Obviously, you get, I did say that assets equals to liabilities plus owner's equity. If you take your assets minus your debt, what's left there is what we call a net asset value. It will tell you whether that business is positive or not, because ultimately you can only sell, that's why it's called the book value of the business as well, by the way. You can only sell the portion of your business that you own.
Sorry, I lost Piri. Wasn't the thing if we can get Piri back, because I lost him.
So to me, net asset value is very important. The next important line on the income statement obviously is retained earnings or net in income. So those ones will tell you whether the business one is not solvent and is profitable, right? But I guess Piri's question is loaded, and we'll talk about when you say profitability and you are making money, for example, 1 rand, how efficient are you in making that 1 rand? Should that 1 rand maybe be 2 rand if you were to be more efficient in generating?
If you stepped up your efficiencies.
Your efficiencies, right? Would your net asset value be much more important if you were to gear or lever properly, because you can actually grow your asset base through debt, but and get your equity portion. So there's the efficiency part of it. But to keep it simplistically, it's when you know that you've got a net positive value in your balance sheet and you're profitable. Those are the two measures on a basic side that you would argue. Obviously, it gets more complicated than that. I know other people will come in and say there's valuations, this and that. But remember, this is finance for entrepreneurs. I'm not talking here about people who are looking to acquire companies or who are looking to invest in companies. This is for us to understand whether we are generating value or not. Remember,
which is the fundamental question Piri is asking.
Yeah, absolutely.
How do I know that my business is actually creating value?
Year in, year out, you look at your net asset value, whether it's growing or not. You look at the growth rate of that. So we are in percentage terms. How big is that growing? You also look at your profitability and you look at how big those are growing. You can actually even delve in deeper, by the way. What I mean by delving deeper, you can look at the operating parts of it and look at over time how well you are doing. You can look at the direct part of it, look how well they are doing. Even on your asset part, you can look at your cash component, look at your fixed asset, and look at how those are doing. But from a glance, if I don't know what that business is from a, or I'm not even wanting to start arguing about efficiency, I look at the net asset value, I look at the profitability.
Piri, I lost you there for a second, and I know you had a follow-up question. Go ahead, sir.
Yeah, no, thanks. I think I'm quite covered. I mean, listening to Mr. Andy is like listening to very good music, Bra Ops. He really makes a great deal of sense. I mean, I'm sure in this series, Bra Ops, going forward, you will discuss, things like management accounting in terms of what that, how, that actually relates is or differs with the financial accounting side of things. And that I'm sure would be able to obviously also provide clarity, because I think that aspect is also of importance. But, I appreciate the answers. And I'm looking forward to the ratio analysis as well.
Much appreciated, Piri and Alex. Please give us a call. I want to inject once again this thought, Andis, that for as long as we are comfortable with being small business, because we are simply at the phase of just subsistence, of just getting by, of just putting food on the table. In other words, we are employed by our own business, versus being a business person who is a serious value creator. If we want to be comfortable at that space, then conversations such as these are not important. I am beginning to understand that it is the understanding of these technicalities that catapults us into another level of business presence, right? And I wish we had a way of being able to simplify even further. But if I can understand some of this stuff, I'm almost sure that 90% of the country can. Why do you think these kinds of technicalities are so difficult for people to have an affinity to?
I think we're all given different strengths, Aubrey. I would not start purporting why people are afraid of it, but it's I'd like to say our education basis as well. I think these things have been great. It's like mathematics as well. I was talking to my daughter this evening, saying to her, "No, I'm going to give her a test of mathematics on Saturday." But I guess what I'm trying, because she's also scared of maths. But one of the things I try to do as a parent is create that comfort of which history, or I guess the background, has taught us that these are concepts for the clever people, without really creating that understanding to say, but do we understand the basics of them? I'm sure in China, mathematics is not a difficult concept, as well as physics and all other things, because everyone is socialized in a way that they understand that. So again, it's a function of our education. I think there's a big space, and this is what we're trying to do as well as an organization. We have a proposition that's called Finishing School, where we take these concepts and we demystify them. Simple concepts like we call them finance for non-finance people. I think this is what also business school use, although those guys are still technical. But it's until you can explain it in a layman, in language that a child can understand.
Yeah, I think the ingredient here is the emotion.
Yeah.
Right. So I think the missing ingredient in financial education and financial understanding is emotion, because it hasn't been understood or taught in ways that make us understand why we need to understand it. We simply get a curriculum or content that says you need to understand this. We don't understand why.
Yeah, exactly. And that's what I mean by a basics education. I was taught some years ago, you call it emotion, I call it a feeling. I was taught some years ago that the physical manifestation of fear and happiness in the body is the same, by the way. In the heart, how the heart is what you interpret by in your mind that will say whether this is fear or whether this is joy and happiness. And again, it's trying to say this thing, I think, lies in the mind, right?
Yeah.
Where if you are taught that these things are tough, if you are socialized in the environment saying that these things are tough, naturally you'll also build this fear, unfounded, by the way, because you actually don't even give it yourself a chance. Well, don't get me wrong, other people do grapple with this, given all the things. But I think what we're trying to create here is at least understand a certain level of it. We did say that you'll outsource the technicalities to a professional, right? But have a sensible enough conversation with them so that you know, one, they're doing the right stuff, and two, to glean from them the bits of information that you need for your value creation.
Give us a call on 011-883-0702 as you begin to understand the value of the income statement, the value of the balance sheet, the value in the creation of value of these documents, and why it's important for you to understand them. Because we can't stay small time forever, folks.
No, absolutely.
Yeah, we cannot stay small time forever. This idea that we are small business people perpetually needs to stop. And where it starts is for us to understand how the valuing of your business is communicated commercially. And what I'm understanding, Andisa, is that we've got to be comfortable with this information. We don't all have to be accountants, but we've got to understand that the income statement has got those three components. And that those three components that you were talking about can help you in prioritizing how you allocate resources, how you change certain parts of the business that may be lacking, purely by just being able to read that income statement. Talk to me about the banks and venture capitalists and their relationship with your balance sheet and your income statement?
Yeah, so those guys will do, okay, there's, so those, the banks.
I should say financiers.
Financiers. Yeah. I think let's distinguish between the two of them, because the venture capitalism buys into the dream. They buy into the future cash flows and what this idea can be. Otherwise, they don't invest. The bank buys into steady income flows. So the two are very different, right? One is very risk aggressive, and the other one is very risk averse. So that's why banks would look at financial statements, they'll look at your balance sheet, and they look at assets, for example, and how much of those assets they can securitize. And if that security is not enough, they look at you as an individual to say, can you cover the balance of can you give us that security, right? They look at the income stream of your business, that operating line, to say, okay, are you generating enough cash to at least service the interest? And they look at history as well. That's why banks are more comfortable with businesses that's got history. They look at history of all these things. How well have you been growing your assets? How well have you been growing your operating margin? How well have you been doing your net margin? In fact, it brings us nicely to the next income statement we'll cover very briefly. So they'll look at those. The venture capitalist guys, they'll look at the financials, but more importantly, the strategy part, right? They'll look at I would say the venture capitalist will look at four things, and I'd love for us to talk about those. There's the context part that let me suspend for now, because we can talk for days. It's about, is your product ready for the market? Think about Facebook in 2001, for example, or in 1999. The market was not, the technology that was available at the time was not ready for Facebook. So venture capitalists will not have invested in that. So let's park the context part, because it's quite important. They look at the context. They will look at your value proposition, the stuff that we've discussed on the desirability side. Do you have a value proposition? Does it address pain points? Is the market big enough? Is it growing? Is it easy to access? What are the cost of acquiring customers? What's the lifetime of the customers? Can you generate enough income? And all those things. They'll also look at the team as well, right? They'll look at the jockeys, they'll look at the experience, they'll look at whether you've got what I call brain power, and you are able to solve problems. So and then they will come back, and it helps when you've developed your product to a minimal stage where it has started to get a certain market adoption, because you can start now. If you started doing some sales, doing some cost and improving on your balance sheet, they will look at that to start analyze those things. So, but yeah, those are two classes of financiers with different risk appetites. One will look at the financials plus the entire strategic stack, desirability, feasibility, and profitability. And the financiers will look at the income, the debt lenders, more the income statement, more the consistency of the cash flows, as well as the asset base that they can securitize.
Philip from Lufureng says, great conversation. Kindly assist in mentioning the different levers that one can use to reduce tax obligation, please. It's as if he was listening to us earlier on off air. And then somebody who obviously knows you, Kagiso Ngati in Midrand says, hi, Bra Aubrey, that man has changed my life from employing me and later grooming me into building my own business. I'm now running a growing business because of him, says Kagiso Ngati. But let's talk about some of these tax obligations and these documents, how they come into that.
Well, for starters, I can't help him evade tax. I think that's, you have to pay your fair share.
Yeah.
But these are not tax evading stuff, right? These are stuff that you use, and I think I've sort of like skimmed a bit on that depreciation, because depreciation, those are non-cash items, things like depreciation, as well as impairments, as well as amortizations and stuff. This is what we call non-cash items, and you're allowed to expense them after the operating profit.
Yeah.
But before So the debt lenders must be paid first before you can then expense those items. So what those things, they've got the impact of reducing your what we call taxable amount. That when you levy the tax rate, you pay effectively. But those are functions of when you run the business. Impairments happens when you had people who are owing you, they are no longer paying, and you don't think there's a chance of them paying you, you can impair them. Depreciation is allowed, but you must have a depreciation policy where it's accounting for the aging of the assets. Again, that will give you a tax benefit. And that's why it's quite important as an entrepreneur to understand these things, to say, what is your impairment policy? What is your depreciation policy? And how can you use that to your benefit? Other people, obviously, without violating accounting standards, would have aggressive, for example, depreciation policies, others not, depending on what you deem your net cash requirements become. But it's very important that you mention these things, because that's why we have what we call a cash flow statement. Yeah. And without boggling you down too much, Aubrey, it's made up now of 3 items. You'll see those things. It's either 3 items this side, 3 items that side. The cash flow statement only accounts for cash moving out, cash moving in the business. And it starts with the opening of a bank account. Then there are stuff that you deduct from operating activities. This is, you deduct or incur. So you get money if there's cash, physical cash that's moving when you sell goods, and when you pay employees, you'll account for those there. You then have another line there is cash from, financing. Okay. In fact, that one comes at the end. It's investment activities. If you buy assets, for example, or if you sell assets, those will come in there, but only cash movements. And final one is financing, which is about financing activities. If you go raise debt, for example, or you pay debt, or if you go issue shares, or you pay shares, or you pay dividends.
Clearly, we need to have a conversation about those ratios, because we didn't even go in there.
Yeah.
But I'm taking away from this, and I'm hoping that our listeners begin to understand this too, that business is not a game of chance.
No.
That business is not a game of happenstance. It's a very deliberate, professional, painstaking process that requires us as entrepreneurs to understand certain principles of accounting. What does accounting mean? It means simply giving the information that tells us of the value of our business.
Yeah.
These things are critical for us to understand, not as accountants, but as business people ourselves, so that we can understand what our business represents.
Yes.
It's critical for us to stop this idea that we will remain small forever.
Yeah.
So that we can become real business people, not just small business people.
Yeah.
It's an aspiration that I believe we need to have as entrepreneurs. How do people get in touch with you, Andisa, as we close?
Yeah, Aubrey. So we are still available. My website is www.ntiyisoconsulting.co.za, or alternatively send us an email at info@ntiyisoconsulting.co.za.
You said we're going to be seeing some of these things on podcasts.
Yeah. You see, Aubrey, I started playing politics there. You know, when you start keeping quiet around you. So the podcast has been shot, has been curated, has been done. I think what we want to do now is have a proper launch, because we want to reach as many of the people as possible. As we've mentioned, this is about continued entrepreneur education. So it's quite important that you get as big amount of people listening to this stuff as possible. So we're trying to align like-minded people. So we have a big strategy. So that's what's delaying the podcast. But we'll come back with the necessary details. But I think realistically, we're looking at the first quarter of next year.
Andisa Ramavunga, Chief Group Advisor at Ntiyiso.